What if thousands of dollars that legally belong to you were sitting in government programs every year, and the only reason you never received them was because nobody ever told you they existed? According to publicly available government information, many Canadian seniors fail to claim benefits, tax credits, and provincial programs they're already eligible to receive. It's not necessarily because they don't qualify, and it's not because the money has run out. In many cases, it's because Canada's retirement support system isn't built around one application. Instead, it's spread across multiple federal departments, provincial governments, tax credits, healthcare programs, and income-minus-tested benefits that operate independently of one another. That means knowing one program doesn't guarantee you'll discover the others. Today, we're breaking down the most important benefits available to Canadian seniors in 2026, not simply listing them, but explaining how the system actually works, why so many eligible people never receive everything they're entitled to, and what actions unlock the largest payments. Let's begin with the biggest change taking effect this year. According to publicly available announcements, the federal government has introduced the Canada Groceries and Essentials benefit, replacing the previous GST credit with a larger tax-minus free payment for eligible Canadians beginning in July 2026. For qualifying seniors, the payment represents roughly a 25% increase compared with the previous benefit. But here's the detail that often surprises people. There is no separate application, no online registration, no special enrollment period. The government determines eligibility almost entirely through one document, your annual income tax return. That creates one of the most common mistakes among retired Canadians. Many seniors believe that if they owe no taxes, they no longer need to file a tax return. From a tax perspective, that assumption may seem reasonable. From a benefits perspective, it can become extremely expensive. Federal agencies use tax returns to calculate eligibility for dozens of income-minus-tested programs. If no return is filed, those agencies may have no updated information to determine whether someone qualifies for payments, even if that person would otherwise receive them automatically. Financial planners often describe filing a tax return after retirement as less of a tax obligation and more of a benefits application. That distinction becomes even more important for lower-minus-income retirees. Several federal and provincial programs, including income supplements, tax credits, and healthcare assistance, are interconnected through the annual tax filing process. This one return, and multiple benefits may be delayed or suspended. That's why experienced retirement advisors frequently recommend filing every year, regardless of income level. And this principle extends far beyond grocery assistance. Whether we're talking about prescription drug coverage, property tax relief, dental care, home accessibility credits, or income supplements, many of Canada's largest senior benefits share one common requirement: not age, not employment history, not even pension status. Simply keeping your tax information current. To understand why so many seniors leave money unclaimed, it helps to look at how Canada's retirement support system is actually built. Many people think there's a single senior benefit program. In reality, Canada's retirement support is layered. Federal benefits, provincial programs, tax credits, healthcare subsidies, and municipal discounts all operate independently. Some are automatic, others require a separate application, and several only become available after specific information appears on your annual tax return. That complexity is where many eligible Canadians miss out. Let's start with healthcare, because this is where many retirees can reduce everyday expenses almost immediately. Once Canadians reach age 65, most provinces expand prescription drug coverage through provincial drug plans. While the details vary between provinces, the basic objective is the same: reduced prescription cost for seniors. For example, Ontario's drug program generally begins automatically after a resident turns 65. However, according to publicly available provincial information, additional low-income assistance programs often require a separate application. If approved, these programs can significantly reduce deductibles and prescription co-minus payments. The same pattern exists across several provinces: British Columbia, Quebec, and others each offer their own versions of senior prescription assistance. The exact income thresholds and application procedures differ, but the principle remains consistent: automatic enrollment in basic coverage does not necessarily include every available subsidy. Healthcare savings don't stop with prescriptions. Many provinces also provide coverage for routine eye examinations, vaccinations, and other preventive services once residents become seniors. Depending on provincial policy and individual circumstances, this can include regular vision exams, influenza vaccinations, shingles vaccines, diabetes-related screenings, and other preventive care that would otherwise require out-minus pocket spending. Another area many homeowners overlook is property tax assistance. Property taxes often become a growing burden during retirement, especially as fixed incomes struggle to keep pace with rising municipal assessments. To address this, several provinces and municipalities offer grants, rebates, or tax deferral programs specifically designed for older homeowners. These programs are not identical. Some provide direct rebates through the annual tax return. Others allow qualified seniors to defer property tax payments until the property is eventually sold. According to publicly available provincial information, eligibility typically depends on factors such as age, income, and home ownership. For homeowners planning to remain in their homes for many years, understanding these programs can improve cash flow without requiring additional borrowing. Home safety improvements may also qualify for federal tax relief. If a renovation is specifically intended to improve accessibility or reduce safety risks such as installing grab bars, wheelchair ramps, stair lifts, wider doorways, or accessible bathrooms, it may qualify under the Federal Home Accessibility Tax Credit, subject to current eligibility rules. The important point isn't memorizing every line of the tax code. It's recognizing that many routine retirement expenses, prescriptions, property taxes, and home modifications may already have government programs designed to offset part of the cost. In the next section, we'll move beyond healthcare and housing to examine the tax credits, pension strategies, and income benefits that, according to financial professionals, often represent the largest long-term savings for Canadian seniors. Once the basic healthcare and housing programs are understood, the next layer of Canada's retirement system becomes even more important. Unlike direct benefit payments, many of these programs reduce the amount of taxed seniors or increase the amount of retirement income they keep each year. Individually, some may appear modest. Combined, however, they can make a meaningful difference over the course of retirement. One of the most fundamental examples is the age amount tax credit. According to current federal tax rules, Canadians aged 65 and older may qualify for an additional non-refundable tax credit, subject to income thresholds that are adjusted periodically. For eligible seniors, this credit reduces federal income tax and is often applied automatically through tax preparation software. Even so, it's worth reviewing every return to confirm that the credit has been claimed correctly. Another frequently overlooked benefit is the pension income amount. Eligible pension income, including many private pensions, qualifying annuities, and certain registered retirement income fund or RIF withdrawals after age 65 may qualify for an additional federal tax credit. While the maximum credit depends on the individual situation, it represents another opportunity to reduce taxable income without changing investment strategy. For retired couples, one of the most valuable planning tools is pension income splitting. Canada's tax system allows eligible couples to allocate a portion of qualifying pension income between spouses. The objective is simple: instead of one spouse reporting significantly more taxable income than the other, income can be distributed more evenly. From a tax perspective, this can lower the household's overall tax bill by reducing the amount of income taxed at higher marginal rates. According to many Canadian financial planners, pension income splitting remains one of the most effective retirement tax strategies available to eligible couples, yet it is still underused because many retirees either don't know it exists or assume it happens automatically. Another major development in recent years is the Canadian Dental Care Plan. Dental expenses have long represented one of the largest out-pocket healthcare costs for retirees, particularly for those without employer-sponsored insurance after leaving the workforce. The federal program now provides coverage for many eligible seniors who meet residency, tax filing, income, and insurance requirements. Depending on household income and the specific dental procedure, eligible participants may receive substantial assistance for services such as examinations, cleanings, fillings, dentures, and other necessary treatments. Eligibility, however, depends on meeting program requirements, and not every dental clinic participates. Before scheduling treatment, seniors should confirm both their eligibility and whether their provider accepts the program. Perhaps the most financially significant benefit for lower-income retirees is the Guaranteed Income Supplement, commonly known as GIS. GIS provides tax-free monthly payments that supplement old age security for eligible seniors with limited income. Financial advisors frequently point to one critical fact: many otherwise eligible seniors lose access to GIS simply because they stop filing annual tax returns after retirement. Since eligibility is reassessed using annual income information, filing taxes each year remains essential even when little or no tax is owed. As we've seen throughout this discussion, Canada's retirement system isn't built around one large payment. Instead, it functions through multiple programs working together. The final question, then, is not simply which benefits exist, but how seniors can build a routine that ensures they continue receiving every benefit they're entitled to, year after year. After looking at the full picture, one conclusion becomes clear. The biggest financial advantage for many Canadian seniors doesn't come from finding one new government program. It comes from understanding how dozens of existing programs work together. Think of Canada's retirement support system as a network rather than a single benefit. Old age security, the Canada Pension Plan, the Guaranteed Income Supplement, tax credits, provincial healthcare programs, property tax relief, prescription drug coverage, transit discounts, and banking benefits all serve different purposes. On their own, each may save only a few $100s a year. Combined, however, they can significantly improve retirees' financial security. The challenge is that very few of these programs actively notify eligible people. Governments generally publish eligibility rules, but they don't contact every senior to explain every available benefit. Banks may offer discounted senior accounts, but customers often need to request them. Municipalities may provide reduced transit fares or recreation programs, but enrollment usually requires an application. Healthcare programs frequently include additional subsidies that become available only after income information has been reviewed. In other words, awareness matters. One practical habit can make a substantial difference. Rather than waiting until tax season, many financial planners recommend conducting a yearly benefit review. Once a year, seniors can verify that their tax return has been filed, confirm that their personal information is current with the Canada Revenue Agency and Service Canada, review any changes in household income, and check whether new federal or provincial programs have been introduced. Government programs evolve over time. Income thresholds change. New tax credits appear. Existing benefits are expanded or adjusted. A program that someone didn't qualify for 2 years ago may become available after retirement income changes or after reaching a new age threshold. Healthcare deserves the same annual review. Prescription coverage, vision care, vaccinations, dental programs, and accessibility assistance can all change as provincial policies are updated. Spending a few minutes reviewing available programs each year may prevent unnecessary out-pocket expenses later. The same applies to financial institutions. Many Canadian banks continue expanding products designed specifically for seniors, including reduced monthly account fees and specialized banking packages. These savings may appear relatively small month to month, but over many years they can reduce routine expenses without requiring any change in lifestyle. Ultimately, the most valuable takeaway isn't any single benefit we've discussed. It's understanding that retirement planning doesn't end when someone begins collecting a pension. Managing retirement income is an ongoing process that includes reviewing tax credits, monitoring eligibility, updating personal information, and making sure every available program is working together as intended. According to publicly available government guidance, many of these benefits are already in place. The difference is whether eligible Canadians know they exist and take the necessary steps to access them. If today's breakdown helped clarify how Canada's senior benefit system works, consider using it as a checklist during your next financial review. Even one overlooked credit or benefit could offset hundreds or in some cases thousands of dollars in annual expenses. And if you found this analysis useful, subscribe for more in-depth explanations of Canadian retirement policy, tax planning, and government benefits. We focus on understanding the rules behind the headlines so you can make better informed financial decisions. Thanks for watching, and I'll see you in the next video.